Yeah. Respected the chairman of Udupi branch of SRP 5CI, CA Kavita M. Paiti, Mysore branch chairman, CA Kumar MG, vice chairman of Udupi branch, CA Lokesh Shetty, sir, and today's speaker, Aditya Kumar, yes, the past chairman of both Mysore as well as Udupi branch of SRP 5CI, and dear members and students, good evening everyone. Today we are all here for the second day of the virtual CPE meeting on accounting standards and standards on audit. Now I request the chairman of Udupi branch of SRC 5CI, C. Kavita M. Paiti, to welcome the gathering.
Good evening to each one of present here. It's my moment of extreme pleasure to welcome you all. On behalf of Udupi branch of ICI, I offer my regards to all people joining us in this second virtual CPE meeting conducted by Mysore and Udupi branch of SISC of ICI. I convey my regards to today's resource person, CA Aditya Kumar. Yes, sir, I welcome you, sir. I hope everyone will be aware of this topic today. So enjoy or concentrate on seminar. Thank you.
Thank you so much, madam.
Thank you, madam. Now I request the vice chairman, CA Lokesh Shetty, sir, to introduce our today's speaker.
Thank you so much, Pradeep, sir. A very good evening, everyone. I welcome you all for this second day of the seminar. It's my great privilege and honor to introduce today's speaker, Aditya Kumar. Yes, he's a partner in the firm. He's a partner in Aditya Group since 2017 at the Bangalore office. He specialized in accounting standards and other financial reporting aspects. As far as his accomplishments are concerned, he is a speaker in professional forums like Society of Auditors, CA Study Circle Meet, all the branches of SISC of ICI, RTC of the C&AG of India, Madras University, and other educational institutions. He has contributed literature and topic of audit and assurance, financial reporting aspects to journals like Auditor, published by the Society of Auditors, Internal Audit Today, published by the Institute of Internal Auditors of India, journal published by the Karnataka State CA Association. He also co-authored book on AI in financial services and contributed to leveraging the data analytics in internal audit. He is also conducting in-house training sessions. As far as his professional experience is concerned, he is specialized in statutory audits, limited reviews of the companies in various industries, including banks, auto and auto components, engineering equipments, electric vehicle, IT and ITES, plantation, sugar and textiles, including subsidiaries of Fortune 500 companies. Is having the experience in internal audit of companies in cement, construction, communication technologies, trading, with an object to improve the operational controls, identify the areas of cost reduction, and better compliance management. He is also experienced in the special assignments relating to the review of the consolidation procedures and benchmarking accounting practices, investigation into fraudulent activities, advising clients on Ind AS, multiple GAAP to Ind AS. He is also involved in the SOX testing of an MNC involved in manufacturing of consumer electronics having global operations, including presence in China, Taiwan, Europe, and US. So here I introduce before you Aditya Kumar. Yes. Over to Pradeep, sir. Thank you so much for this opportunity. Thank you, sir.
Thank you, sir. Over to Aditya, sir.
Thank you, Mr. Lokesh, Mr. Pradeep, for the introduction. And couple of things. We just hope the internet connection works, and I have a backup just in case there's a hiccup. Just don't get worried. I'll try to put it up, fix it as soon as possible.
No issue, sir.
Second, where the participants have any doubts or anything, they can always ask either through chat box or they can raise their hand, and possibly we can have an interactive session, because see, we're all members, we know what the standards are. It is just that we are just trying to refresh whatever we know and just share our experiences in our day-to-day attestation services as to how we have carried on and how we have taken certain positions, right? So that's about it. I will start my presentation right away. Okay, thank you. Just to conserve the bandwidth, I have switched off the video.
Okay, sir. Fine. No issues.
Is my screen visible?
Sir, kindly proceed. It is visible.
Okay, great. So on standards of auditing is the webinar all about. And today we have about 5 standards that we are going to discuss. SA 700, 701. These two belong to the family of audit reports. SA 500 and 501, again, it deals with the family of what type of audit evidence needs to be collected and how it needs to be used in our audit. 330 is basically comes into the family of audit planning, risk assessment in that category. So SA 700 and 701 are quite huge standards and will take substantial portion of time. We will also go through some of the case studies, live case studies and FAQs. I have also considered the opinions given by the Quality Review Board and the implementation guide. These literatures are also available on ICI website, which I would encourage members to download them and read it. It's a very, very useful, what you call it as a literature. Coming to SS 700, forming an opinion on reporting on the financial statements. One of the very important aspects that we need to understand in this particular standard or the family of the standard is it helps us to give or make decisions on how we need to conclude our audit opinion and what are the different paragraphs that needs to be mentioned in the audit report. Okay. This audit report has undergone a lot of changes from, can say, the last 5-6 years in terms of its content, the quality, the reporting requirements, etc. In fact, even as late as last month, when the Companies Act was amended, they have introduced a lot more reporting requirements under the Companies Act as well as under CARO. So in our standards of auditing, it is still getting evolved. I will also share with you certain international audit report wherein you get a clue as what you can expect in the next round of revision. And all that I can say is our audit reports are going to be lengthier. It is going to have a lot of content and it will address a lot of stakeholders' requirements as well. Most of these standards, or rather all of these standards, are basically taken from the international standards of auditing, which is governed by International Auditing and Assurance Standard Board. Now, India being part of the IASB, we take the as auditing standards, and where it is required, we try to modify them to suit the Indian requirements. But having said that, if you go through all these standards, it is more or less the same. Now, SS 700 and 701 are the two standards that which we are going to cover in this session. You have other standards on modifications, emphasis of matter, comparative information, other information where auditors have to read and report. Those are the standards. If time permits, possibly we can discuss at the end or we can leave it as it is. But the main agenda is on SA 700 and 701. Now, what are the contents of the audit report? If you would look at an audit report, basically it has 3 parts. One is the report on the financial statements. That is, we call it as the main report. Then we have company audit report order, typically for certain companies, because CARO also has certain exceptions. If those exceptions are covered, CARO will not be applicable. Otherwise, CARO is also applicable. Right now, CARO 2016 is what we are following, and from next year, as amended, CARO 2020 will be followed. And the third part of the report is the report on internal financial controls over financial reporting. Again, there are certain exceptions for that. Certain companies or smaller companies need not follow that. The auditor's responsibility is to report on internal financial controls over financial reporting. Apart from these three, in case of public sector companies, you would also see the sub-directions given by the Central Comptroller and Auditor General of India. So the auditors of public sector companies would also have to give an additional report to the C&AG, which also forms part of the audit report. So the contents broadly are 4 different parts. If I take just a step back and see how SA 700 revised has been evolved, on your left-hand side, you see the old format. On the right-hand side, on the table, you will see the new format. It is not only the format that has undergone a change, wherein the paragraphs have been rearranged. There are a lot of other information, there are a lot of other paragraphs, for example, giving material uncertainty relating to going concern, which otherwise would have been covered in emphasis of matter, is now a separate paragraph. Key audit matters, a very, very important and very, very hot topic among the auditor circle being discussed. Other information, the management's responsibility statement, it has undergone a tremendous change. So there are a lot of changes that we are expecting in the new format, and there will also be further changes which I'm going to showcase at the end of this presentation as well as a case study. SA 700 revised is a very, very new standard. It's about 2 years that we got the standard. Here, our objective is to form an opinion on the financial statements based on our audit procedures. And we all know that the audit report has to be given in the written format only. As far as the scope of the audit is concerned, it is basically deals with only general purpose financial statements. That means it deals with those financial statements like balance sheet, profit and loss account, cash flow statement, notes to accounts, and significant accounting policies. In case of companies which have Ind AS, they will have to present statement of changes in equity and other comprehensive income, which is again part of the P&L as such in Indian scenario. Now, why is this important to understand? In our profession, we come across not only attestation of the financial statements, we do a lot of attestation work for any information which includes financial information also. I can just give a small example. Say, for example, you're doing audit of a company which is incorporated in India. However, for its holding company is say in US. For the purpose of consolidation, the company prepares accounts under US GAAP from January to December. Now, this is also a financial statement, but it is not a general purpose financial statement because it is not available for the general public or to the regulators or to the stakeholders of the company, like vendors or IT department or anybody. This particular financial statement or information is made available only for the purpose of consolidation with another particular entity. Then it becomes a special purpose financial statement for which SA 800 series will apply and not SA 700 series. So typically SA 700 series will apply only to general purpose financial statements. What are the broad contents? Broad contents of the audit report that we are talking about in SS 700 will be identifying the document. Identifying the document means your audit report typically has a title called as Independent Auditor's Report. Most of you who have been in practice for a pretty long time, they would know that initially the audit report was just titled as Auditor's Report. There was no mention of independent word in it. When SS 700 came into the picture, they revised saying that it has to be mentioned as independent auditor's report to convey a message to the reader of the financial statements that the auditor is independent in this regard and this is the report that is given. This is identifying the document. After the document is identified, normally we address it to the members of the company, at times to the president of India if it is a public sector company, etc. After that comes opinion and basis of such opinion. It is not enough just to give an opinion, but you also have to give a paragraph on how you have concluded that your opinion is substantiated. What are the things that you have done to substantiate that? We will go through each of these a bit later. Then comes the responsibilities of the auditor. Again, this is what do you call it as a huge paragraph which starts right from the audit planning, use of audit sampling techniques, risk assessment, identifying the fraud risk, right? Assessment of going concern. All these are the responsibilities of the auditor, which also clearly mentions that we are not responsible for preparing the financial statements. We only have the responsibility to give an opinion on that. Then comes responsibilities of the management, wherein the management, we are making it very clear that the financial statements are the responsibility of the management. This key audit matter is a paragraph which we are going to discuss as a separate topic. Emphasis of a matter paragraph would come later, just to give a touch of what is it. When we read a book, wherever there are important points, possibly we have the habit of highlighting it. At least those who are in my batch or in the seniors batch who have the habit of reading the book, not the e-version of it, we keep highlighting it. Typically, emphasis of matter acts as a highlighter. So wherever there's a note in the financial statements which is required to be highlighted, which is of importance, will come in emphasis of matter. Other matters basically deals with nothing to do with the financials, but with the auditor's responsibilities. We have an example for that as well, which we are going to discuss. Then there is a separate note given on going concern aspects, which is again covered under SA 570, which was also amended parallelly with SA 706. Information given in other documents like annual report, which contains the director's report, etc. Wherever there are audited numbers, the auditor is expected to read that and then comment in the audit report whether there is consistency in that. Where the draft director's report are not available, he has to categorically mention in the audit report that as on the date of audit report, it is not available. Therefore, he will not be able to comment. But as and when it is made available, he will comply with SA 720. Then you have all your section 143.1 to 143.3, which requires a lot of information to be given on whether the company has maintained proper books of accounts, whether the financial statements match with the books of accounts, right? Are there any adverse opinion, then compliance with accounting standards, etc. If at all there is any additional reporting requirements like RO, IFC, etc., will come as part of regulatory or legal requirements separately. Broadly, this is how SA 700 is structured. What are the things that, as an auditor, we need to consider before? I am not getting into the audit procedures. Audit procedures is something which we are all aware of. Before getting into the audit report, broadly, we identify critical areas. Some of the critical areas that I have listed down is what type of accounting policies are the company following, right? Whether those accounting policies are aligned with the respective accounting standards. Does it meet the reporting requirements of such accounting standards? And most importantly, is the selection of accounting policies. That is where I guess as professionals, we need to understand. For example, say a company is following FIFO method of valuation. But if you look at the annual report of the other companies within the same industry, they might be following weighted average, right? Or if some company is having plant and machinery whose life is estimated to be 7 years or 10 years, whereas industry standard is something different from that. It is important as professionals for us to evaluate whether the accounting policies and accounting estimates are reasonable, are consistent over a period of time, and how does it gel well with the rest of the industry. For a moment, I'm not saying that the company has to follow what the industry follows. There could be certain valid reasons as to why there is a small deviation here and there. As auditors, we need to understand as to why it is quite different from what is the industry norm or what is the industry that is being followed. Other very important aspect here is whenever there is a change in accounting standard or wherever there is additional disclosure requirements by the Companies Act or any other regulation, it is important for the auditor to ensure that the accounting policies are aligned to the requirements. If it is mandatory, they have to do it. If it is voluntary, then they may have to disclose as to why they have chosen or not chosen it, etc. And what is the impact in the financials will also have to be disclosed. So broadly, when it comes to accounting policies, whether it is under AS1 or under Ind AS 1, it is very, very important for the professional to analyze, evaluate, and then conclude whether these accounting policies are good enough. They don't have any reservations. Then comes the second part on the financial statements. In the financial statements, you have a lot of schedules, groupings, disclosures that get audited. Now, there could be scenarios where certain financial statements may contain certain information which may not be irrelevant or which is more of a management interest or the stakeholders' interest and nothing to do with what do you call it as requirement under an accounting standard or under the company law. In those cases, it is the duty of the auditor to figure out whether these information given in the financial statements are relevant, comparable, and understandable. You cannot have something written in such a very technical manner that it is either very vague or ambiguous or what do you call it as in local language, it's a bouncer, nobody will understand. Just a small deviation on this topic. Under Ind AS, there is a change in the definition of materiality. If you look into the new definition of materiality, you will find that it also covers the quality of the information given in the financial statements, which is in the literature form. That means if your literature or the notes to accounts is so complex or so technical, there is a potential risk of some key information being camouflaged or some critical information being missed out. To what the standard setters now have done is they have brought that also into the gamut of materiality, wherein the auditors need to assess and see whether the language that is used are understandable. So what is understandable is again a matter of professional judgment and debate. After that comes the overall presentation of financial statements. In India, for companies, it's Schedule 3. Within Schedule 3, for non-Ind AS companies, it will be Part 1 or Division 1, and for Ind AS companies, it will be Division 2. And of course, if you are an electricity company or insurance company or banking company, you will have the respective regulations indicating what should be the content of the financial statements. Then you have certain requirements under specific law or regulation like the Companies Act, wherein you may have to report certain aspects under 143.1 or 143.3 or any other regulation. For example, SEBI may have a regulation on that. All this have to be basically covered before we give or we even attempt to draft the audit report. Of course, there are a lot of other things, but I felt that this 5, 6, 7 points are very, very important here. In the audit report, basically, any stakeholder would be looking at two important things, whether it is modified or whether it is unmodified. Normally, unmodified reports, we call it as a clean report. So it doesn't have any qualifications. We have already covered what is general purpose financial statement. Similar to that is when we are giving an unmodified opinion, we could give either for a financial statement which is prepared under true and fair framework, or what we call it as fair presentation framework, which is predominant in India. If you read the Companies Act, and if you all know that we always mention that it shows true and fair view. There are certain cases where, though it is required by law, it could only be a compliance requirement. That means you are not going to sit in the judgment whether this is true and fair, but you are only going to ensure that the financial statements given are in compliance with a particular requirement of the law or particular requirement of the regulation. But however it is, whether it is in compliance or fair presentation, your SA 700 will remain the same. So instead of mentioning the financial statements show a true and fair view, we would be mentioning the financial statements are in compliance with so and so framework or so and so requirement of the law. That is how the wordings would. So where there's an unmodified opinion, that means the auditor does not have any reservations based on this audit procedures, and he has given a clean report. Where there are issues, you have a modified report. Modification is covered under SA 705, which deals with either it is a qualification or adverse opinion or disclaimer of opinion. Normally, these are given when the financial statements and the disclosures are materially misstated or the auditor is unable to conclude on the opinion. Wherever the financial statements, say for example, one portion of financial statements are misstated, for example, inventory is not complied with Ind AS 2 or ES 2, then the auditors will have to mention in the audit report. It will not be opinion, it will be called as qualified opinion. The title should also change. You should not be writing opinion, you should be writing qualified opinion. So the moment somebody reads it, they should, alarm should trigger that there is something wrong in the financials. In the next paragraph, it will always be basis of qualified opinion. Similarly, when there's an adverse opinion, you will have adverse opinion and basis of adverse opinion, and same with disclaimer of opinion as well. All these three are covered under modifications. Emphasis of matter and other matters, going concern, and auditor's responsibility on reading other information. These are not modifications. These are other reporting requirements under SA 700 and the related standards. So that is about what is modified and what is unmodified. Some of the other aspects, most of it we would have dealt before. It has to be in writing. Of course, now it is allowed to sign audit reports digitally, which was like not very popular before. Now, thanks to this COVID issues and other things, people not able to travel, we are signing it digitally. In the basis of opinion, we also now have to include compliance with the code of ethics, independence, standards of auditing, etc. So once we go through that paragraph, we will be able to know what are the requirements there. So what are the management responsibilities? Management responsibilities, it starts with the word are those charged with governance. When we say those charged with governance, we mean that who is running the show. For example, in case of a company, it would be the board of directors. So when we say the board of directors, we'll have to mention that the responsibility of preparing the financial statements lies with the board of directors. Or if it is any other body like a trust or something like that, we will be mentioning it is with the trustees. So it is very important to identify who is responsible for preparing ultimately who is responsible for the financial statements. And those people who are responsible for the preparation of financial statements are also responsible for selecting the accounting policies, or whether also on the internal controls, setting up the internal controls and ensuring that they are effectively operating throughout the year, right? Then financials are rather free from material misstatements, going concern assumptions. These are some of the fundamental things that the management is responsible for. What is our responsibility? Our responsibility is to give a reasonable assurance. In our audit report, we always mention that we are giving a reasonable assurance. For limited review, we don't give any assurance. Neither we are giving any guarantee in the audit report. That is something which the readers of the financial statement should understand. A reasonable assurance that the financial statements are not materially misstated, but then if there is a fraud or if there is any error, which the auditor has done all the due diligence, has done all the compliance with the standards of auditing, but even then, if there is a fraud or if there is an error, there could be certain misstatements. Why is that statement given? Because we always do a sample check, we do some inquiry procedures, we do some analytical procedures, which will not be covering 100% of the population. Therefore, we always sort of give a window to say that yes, we have done all this, but I'm not saying it's 100% correct. It's a reasonable assurance. Then there's this definition or description of materiality. This is something very, very important because this particular paragraph is also undergoing a change. I will show you a case study as to how this paragraph is undergoing a tremendous change along with our assessment of risk of material misstatement. These two paragraphs are undergoing a lot of change, which I'm going to discuss in the case study as well. What happens in case of materiality? We have to define in the audit report as to how we have arrived at the materiality. Now, does it require quantification? Right now, under SA 700, it is not required. But if you see the international standards, they are even quantifying the materiality, which I believe will come into India eventually in next 1 or 2 years. Then comes understanding the internal control system. Now, whenever it comes to internal control system, we'll have to understand that we are referring to internal financial control over financial reporting. Now, the Companies Act has been amended. Now it is called as internal financial control over financial statements. They are not using the word reporting, they are now using the word financial statements. And how we have evaluated such controls. What if there are companies where IFC is not applicable? There is no reporting requirement. When I say it is not applicable, it means it is not applicable to be reported. IFC is always required in any entity for that matter. In those cases, our audit responsibility will be tweaked to say that we have evaluated the internal financial control system, but not for the purpose of expressing an opinion. So that is also something which we need to keep in mind. Then comes appropriateness of disclosures of estimates and other things, right? Which again includes a lot of professional judgment. Going concern, separate topic under SA 570. Now, typically under SA 570, just to brief what exactly is the requirement, let us take a case where a company has prepared its financial statement and it has evaluated going concern. There is nothing else to be reported. Even the auditor has to evaluate it and leave it there. Don't have to specifically mention in the audit report. Now come to a case where the going concern is questionable, whereas the management has not given any note in the financial statement. It has not given any note. If the management has not given any note in the financial statements, though going concern is questioned, it is challenged, and the auditor has concluded that the financial statements are materially misstated, they should have prepared it on going concern basis. Sorry, they should have prepared it on a liquidating basis and not on a going concern basis. Then the auditor should see the gravity of the situation and then either have to modify the report. When we say modify, they will have to go with qualification or adverse opinion or disclaimer, depending on the situation. But what if the going concern is an issue and the management knows that there are the company is going to be wound down and they have explained it in the audit report, in the financial statements. If the company has already explained it, there's nothing to modify because the financial statements are not materially misstated, then the auditor will have to give a separate paragraph on uncertainty or going concern. And right, earlier it was a part of emphasis of matter. Now it is not part of emphasis of matter. It will be a separate paragraph. Then comes compliance with other laws and regulations and accounting standards, etc. Reliance placed on other auditors. Typically, this is covered under other matters where the auditor will, in case of branch audit, for example, you would have relied upon the branch auditors, or preparing consolidated financial statements, you would have relied upon the audit report of the subsidiaries, associates, and joint ventures. Right. Now, one aspect which is typically different in international standards is the auditor's responsibility can be mentioned in the website of that audit firm. But in India, this is not permissible. We don't have such guidance or regulation. Having said that, we just mention what is given in the standards of auditing in the audit report. Now, typically, what are the practical issues that possibly one can encounter while actually using SSR? Now, what if the financial statements are prepared for a group in a particular format to be given to a holding company or to some other purpose? Say for a contract, they would require a particular purpose. I don't know how many of you have heard the concept of combined financial statements. We would normally know about standalone financial statements and consolidated financial statements. You can also look into website of ICA where they have given a guidance note on combined financial statements. So what is a combined financial statement? Say you have two units and you want to demerge these two units to another company. For that purpose, you have prepared a financial statement by summing up the results of these two units or two subsidiaries. That is not consolidation, neither that is standalone. It is called as combined financial statements, which are not general purpose financial statements. So you have lots of varieties of financial statements, and anything apart from general purpose financial statement, you would have to follow SA 800. Okay. Now, what if you have financial statements prepared, say under IFRS or US GAAP, along with the Indian GAAP? SA 700 will still apply even if the financial statements are prepared under IFRS or US GAAP. The reason being, these are recognized financial reporting framework. And even with this IFRS or US GAAP, the implementation guide clearly indicates that these are applicable to full-fledged financial statements. When I'm saying financial statements, they are full-fledged financial statements. And therefore, even if the accounts are prepared under IFRS and US GAAP, it is the duty of auditor to comply with SA 700 accordingly if it is a full-fledged financial statement. Now, if there are any issues in the accounts or there is lapse of control, etc., is it essential to discuss with the management whether the report is modified or not? By thumb rule, wherever there is an audit report, we normally issue a draft audit report, say to those in charge with management or the directors. Typically, it is given to the CFO or the company secretary for them to give a feedback on any issues that they have or it's something that we have not evaluated. So it is essential to discuss with the management, especially when there is a modification. Give a chance to them to respond. See whether you can look into it again. If you still feel that the modification should stand, we'll have to go ahead with it. Now, another question that somebody would have asked is, can there be a departure from the format given? Now, typically what happens is in the standards of auditing that we have, SS 700 of course is mandatory, but if you would also look at it, in the end of SS 700, they would have given illustrative audit report format. So the question was, when they say illustrative, is it required that we follow the same format? Should we not modify? Don't we have freedom to modify the audit report content? Implementation guide indicates that no, you cannot. The format given in the standards of auditing, though it is mentioned as illustrative, the illustrative is applicable in certain scenarios that they would have given. Scenarios are illustrative, not the format. Therefore, we would have to comply with whatever is the illustration given in SA 700. Then, if the management has failed to have appropriate internal control, should the auditor modify the management's responsibility statement? No, we cannot touch that management's responsibility statement. You just have to copy whatever is given in the standard and put it there. We can neither alter anything in the auditor's responsibility statement also. These two paragraphs will remain untouched. It is to be reproduced as given in the law or as given in the standard. In case of auditor's responsibility, you would tweak only in one circumstance, which I can think of, is where the company or the auditor need not report on internal financial control. To that extent, there could be some amendment to it or corrections. So these are some of the questions. Now, when a company is preparing a consolidated financial statement, the question is, who is responsible for it? The subsidiaries' financial statements are, of course, the responsibility of that particular subsidiary or joint venture or associate. But when it comes to the consolidated financial statement, it is always the holding company's board of directors who are held responsible for the preparation and presentation of the consolidated financial statements. We cannot be mentioning that the financial statements of the subsidiaries are responsible for the or the management of the subsidiaries are responsible for subsidiaries accounts, because we are not reporting on subsidiary, we are reporting only on the holding company's consolidated financial statements. The second one we have already covered, where the IFC is not applicable, we mentioned that, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. Friends, I would encourage you to go back to the era where we did not have IFC reporting, say before 2014 or 13. If you look at those audit reports, this was a standard sentence given in all the audit reports. But this sentence now would be modified wherever we are doing IFC report. The next one also I have covered that yes, the standard provides that the auditor's responsibility can be mentioned in the website and give a reference to that in the audit report. But as of now, in India, we don't have such regulation or such provisions. Is it essential to have a paragraph on material uncertainty related to going concern for all the entities? Not required. You will have to just go with SA 570, but the reference to this paragraph will always be there in the auditor's responsibility that they have evaluated the going concern. The other question that comes under SA 700 is key audit matter mandatory? It is mandatory for listed companies, but it is not mandatory for unlisted entities or unlisted companies. If the auditor chooses to give, we are more than happy to give, but it is not mandatory for unlisted companies. Typically, again, we'll have to evaluate the scenarios here. Say the holding company is listed, therefore key audit matter is applicable. The holding company's auditor may give group audit instructions to the subsidiaries auditors and the auditors of joint venture and associate. When they are giving such group audit instructions, the holding company's auditor may require the subsidiaries auditor or the components auditor, so to say, to report on any key audit matter. In those cases, yes, the subsidiary auditor may choose to give key audit matter in the audit report. About the materiality, as I said, we are going to see a change in this particular thing, but as of now, we are only giving the literature that how the materiality has been derived, what is its definition, and despite having materiality levels and sample checks and analytical procedures, there could be scenarios where there could be certain fraud or error which remains unearthed because of the inherent limitations in the audit. Is it possible to report on financial statements prepared under multiple financial reporting framework? Yes, it is possible. It is possible not only under IFRS or Indian GAAP. I have a particular case which I would like to share with you. Say we are auditors of a life insurance company. The accounts of the life insurance company are prepared based on the requirements of IRDA. IRDA gives the format. Just like how the RBI has the format for banks, IRDA gives the format for the insurance companies. However, the insurance company has an holding company which is listed and which is under Ind AS. Now, for life insurance companies, Ind AS is still not applicable. It has been pushed again by IRDA. Now, what happens? For the purpose of consolidation, the insurance company prepares its financial statements under Ind AS. Now, both the financial statements, either for IRDA and for Ind AS, are prepared, but their results will vary. The performance, that is the profit or loss, will vary. We have seen cases where under IRDA it could be a loss, whereas under INDAS it could be a profit, or it's a profit under IRDA format and it could be a loss under INDAS. Now, which one is right? It's not the question is which one is right or wrong. It is which one is aligned to the standards. Now, both of them are aligned to the respective standards. In that case, what we have to do is use the other matter paragraph. In other matters, what we mentioned, we cross-refer the reports. That means in IRDA accounts audit report, we mentioned that we have also audited the financial statements under INDAS for the purpose of consolidation, and we have given an unmodified opinion there. In the accounts that is prepared under INDAS, we give another matter paragraph saying that we have also audited the financial statements under IRDA guidelines or accounting standards applicable to it, and whether we have modified or we have given an unmodified opinion. The reason why we need to give this is a reader of the financial statement would then understand that it has got nothing to do with the numbers, it has got to do with the different yardsticks or different standards that are being used to prepare the financial statements. Otherwise, what would happen? They will get confused as to, in one set of accounts, you say one result, in another set of accounts, you're showing another result. To avoid the confusion, to clear the air, it is important that we have to mention in our other matter paragraph accordingly. Now, there could be scenarios where the law or the regulation prescribes a format of the audit reports. Typically, say under tax audit, right? We're all doing tax audits. Your Form 3CA, which gives you the format in which it has to be prepared and reported. Now, if you look at Form 3CA, it has got nothing to do with SA 700 compliance, right? So similarly, there could be other regulations where you may have to give an audit report, which the format is given by the law. Wherever the format is given by the law or regulation, we simply comply with such regulation. But where it is possible to align with the SA 700, to the extent possible, we can align, not beyond that. And we cannot even tweak the requirements of the law or the regulation also. Similarly, wherever we are giving certificates also, if you look at it, we cannot be giving certificates like to whomsoever it may concern and etc. If you look at the guidance note on the certificates issued by ICI, the format of the guidance note on certificates is more or less in line with SA 700. So even when you give a certificate, you will have to mention to whom, what is your opinion. There also we are giving an opinion, then basis, responsibility of the management, responsibility of the practitioner or the auditor. Why I call it as practitioner is possibly you might be giving certificates for which you are not an auditor. Then you would be calling yourself as a practitioner or a consultant, right? Then the opinion, and then give it as an annexure to the certificate. So there are a lot of guidance notes also that needs to be seen. Another question that comes is, can I do the audit under two different auditing standards, like standards of auditing in India and international standards of auditing may be required for some other purpose? Yes, definitely. But in your audit report, you will have to mention that we have complied with international standards of auditing or UK standards of auditing or standards of auditing issued by Institute of Chartered Accountants of India and blessed by the Companies Act. Yes, it is possible to give two different audit reports under two different auditing standards framework as well. One more question is, there could be scenarios where supplementary information is given. What is supplementary information? There is a listed company, possibly you can Google and find out, called as Cerebra Technologies. They have given in their audit, since it's in public domain, and I'm telling you this, and of course, we are neither auditors or neither connected to that company in any manner. It's just for education purposes. If you look at that financial statements under the debtor schedule, they have given a comment saying that 66% of these trade receivables have been recovered by the management at the time of printing the annual report. statement that the company was giving. Now, what is the issue? The issue here is this particular statement saying that 66% of the money has been recovered is a supplementary information. Nowhere it is required under either Schedule 3 or under accounting standard to mention how much money is recovered. They're only giving an aging analysis and some classifications. If you are giving any information which is over and above that is required and which is only adding, you can say tax value, but it is more of a supplementary information. That information, now it's the question whether that is audited or not audited. Now, typically when those draft financial statements or whatever is subject to audit is given, the auditor has to see whether this information is relevant, is it requirement of the law or the accounting standard. If it is not, nothing wrong in writing that information, but it has to be labeled as unaudited. It has to be clearly put under a separate heading and mentioned that this particular information is unaudited. Now, in this particular case, what has happened, since they have not labeled it as unaudited, I will presume that the auditor has also validated the 66% number, which is not possible because the audit report is on some particular date and just the printing of the annual report will definitely be after 1 or 2 months, depending on when the board meeting and the AGM is all held and the annual reports are circulated. Now, then what happens when the auditor says that I have audited this financial statement, this particular remark will also be part of financial statement which has not been audited. So inherently or obviously this is a disconnect and unnecessarily the auditor is taking a responsibility on a particular remark given in the financial statement which is not required, which is not audited. Why take the risk? Therefore, wherever there is supplementary information given, you have to educate the management that it is at best for other purposes and it is unaudited. If it has to be audited, then it can be audited separately under other standards and other certifications. That is fine. But it cannot be forming part of the financial statements framework. Okay, the first one we have already covered it. There could be scenarios wherein under IGAAP there could be certain modifications or under US GAAP there could be modifications, but in another framework there need not be any modification. Quite possible, but as what we advise to our clients wherever it is there, this scenario exists to give a reconciliation of profit or loss in the financial statements so that the user will know that why there is a difference in the results. What if a statute or a court order or government directive permits an accounting treatment which is a departure from the applicable standards? Now, typically this will happen, when, say, for example, there's a company which is demerging its operations. When it is demerging its operations, you would find that normally, once the demerger happens, the assets minus liabilities, the difference will be taken as profit or loss on sale of business or discontinuing operations. There could be typical scenarios where once demerger happens, it is not getting into P&L account, but it is getting into balance sheet as a receivable or as a liability, which is incorrect as per the accounting standard. But there is a court order, there is a government directive which permits that accounting to. In those cases, the institute has clarified very clearly that the auditor need not qualify the accounts, but that such departure should be given in the emphasis of matter paragraph and not as a qualification. Having said that, suppose if the court order or the regulation or the directive says that, say it has to be valued at so and so in asset or liability, and such valuation is incorrect, then the auditor has to qualify it, saying that though there is a directive like this, the company has deviated from such directions. Otherwise, it will only be in emphasis of matter paragraph. What is the live case that you can actually see? Some of these government companies in Andhra Pradesh, if you look at it, which recently got split between Andhra Pradesh and Telangana, many of the government companies were split between, say, Andhra Pradesh Civil Supplies, Andhra Pradesh Road Transport Corporation, etc. When it got split, certain assets and liabilities were transferred to Telangana state, and they had their own Telangana State Road Transport Corporation. Now, this is nothing but a demerger of certain assets and liabilities. When there is this demerger, if you see their financial statements, the resulting loss or gain is not there in P&L account, but it is taken as an asset or a liability in the balance sheet as a receivable from the government or payable to the government. Because if you look at the notes to accounts, there's a separate regulation behind that. There's a separate committee which has decided this. So you will appreciate that even though it may not be in strict compliance with accounting standards, there are certain departures from it, which again is not qualified, it is given in emphasis of matter paragraph. Then, if legally there are certain assertions are modified, for example, say a director is disqualified under section 164(2), should it affect the financial statements? Not always. You will have to look it on case to case basis and then see whether it really affects. If it does not affect, we don't have to modify the financial statements. We just have to modify that particular statement in the audit report that the company has not complied with section 164. Similarly, you will also have a case whether the company has remitted all the dues to Investor Education Protection Fund. Well, here there could be a case where the company has not remitted, then you mention that as it is. What if the company is supposed to remit, right, and it has not even made an accounting entry in the books, then yes, depending on the materiality and seriousness, it has to come as a qualification also. Again, it is very subjective. Can the auditor sign the report digitally? Yes, now it is permissible to sign the report digitally. It is permissible now. If you look at the QRB comments or the peer review comments on the audit reports, typically many of the auditors, our own brothers and sisters, possibly they would not have given the titles to the paragraph, or paragraph would have the language which is not given in the standard, right? Possibly the order of paragraphs are changed. Say the basis of opinion has come first and the opinion has come later. KM is given at the end. No, it should not be done. You just have to follow the order given under the SA 700, 701 and the other standards. Many times matters that needs to be modified. I have an example for this. The matters that is supposed to be given as adverse opinion has been taken as qualification, or something that needs to be qualified has gone to emphasis of matter. Somewhere there is a notion among some of the members that instead of qualifying, can we give it an emphasis of matter? No, it is emphasis of matter is not a replacement for qualification. That is something which we have to keep in mind. Many audit reports, if you see, they have not defined what is materiality. These are some of the common observations that the peer reviewer or the QRB have identified. So, so far, so good on SA 700. If audience have any doubt, possibly they can ask the doubt now, or can we move on to the next standard? Is my speed okay, Mr. Lokesh or Mr. Pradeep, Kavita madam? So Pradeep, so Lokesh,
Yes, sir.
is my speed okay? Do I have to slow down or speed on up?
No, sir, it's okay, sir.
Oh, fine. So can I move to the next standard, or would you like to have Q&A for this particular topic?
There is no question, sir. We can move later
Oh.
on. If there is any questions, we can come back, sir.
Sure. Thank you so much. Okay. SA 701 is typically a very important topic, and largely discussed when it was introduced. And of course, to be honest, it is one of my favorite standards as well. Now, if somebody wants to understand what KAM is all about, you just have to read what is given in the shaded area. This is something Sir David Tweedy, who is the former chairman of IASB, and he was a partner in KPMG globally. he put it very, very crisply. He says, these are the matters which kept the auditor awake at night. Means all your audit issues which didn't allow you to sleep, those are the things which would come under KAM. What are the arguments that you had with the CFO? What were the big estimates? The contentious accounting policies, etc. So typically, key audit matters are those matters which you would consider as very, very important thing for that particular audit. It is not a qualification. It is not an emphasis of matter. It is not a disclaimer of opinion. It is none of these. It is those matters which you feel that the stakeholders would be interested to know or would help them to know about the financial statements. For example, even if you look at many of the software companies or IT companies, here KAM will include on revenue recognition, right? Why? Many of them would like to know how did they recognize revenue. For example, if you look at the audit report of, say, Wipro or Infosys or TCS or Cognizant, Oracle, etc., you would be surprised that you will have KAM definitely on revenue recognition where they would have mentioned how did they recognize long-term contracts, how did they recognize cost plus contracts, right? What are the audit procedures they have done? That's all it is required to be mentioned in KAM. Similarly, if you look into some of the manufacturing companies, possibly inventory could be a KAM, right? Or tax accounting could be a KAM. If you look at some of the, what do you call it as the startups, right? Possibly the capital structure could be a KAM. Companies would have issued complex instruments like FCCBs or cumulatively convertible preference shares, etc. If not any of these, say your client is undergoing an IT transformation and you have spent a lot of time in trying to understand the new infrastructure, the new controls, that again itself is a key audit matter. So sum and substance here is when you do an audit, what is that most significant thing that was there in that audit and you had to spend enormous amount of time and effort and professional skill set to form an opinion. That is what is KAM. Now, how do we know what is KAM and what is not? There are three or four steps involved. That we will come to it later. But typically, the items that get into KAM are those which are matters. I mean, the spelling is an error. I will correct it later. These are the matters that are communicated to those charged with governance. Right? If you look at SA 260, there are certain items that you necessarily have to report to those charged with governance. SA 265 deals with those charged with management, but this is typically those charged with governance. Then when you do a risk assessment, possibly you are identifying certain areas where there is a higher risk of material misstatement. Typically, those areas could be revenue recognition, employee benefits, right? ESOP accounting, inventory accounting. Depends on company to company and which standards would apply to them. So if you are going to assess that there is going to be a material misstatement, or there's a potential risk of material misstatement, which you would have identified during, using SA 315, 320, etc., then yes, there could be a case that that particular item could be a key audit matter. Now, what are the examples? This is a typical example of TCS, if you look at it, wherein, as I said, they have given revenue recognition fixed price contracts. Now, here, if you look at it, they have given the company inter alia engages in fixed price contract, the note number, then what is the risk that the auditor is having? The risk they are saying is there could be a fraud risk on the accuracy, there could be application risk, there could be cases where Ind AS 115 may not have been applied, right? Or there could be onerous obligations which they would not have anticipated, right? Or there could be work in progress at the end of the year, right? Now, to mitigate these risks, what is the audit procedure followed? So our audit procedures included the following. So they have mentioned that they did inquiry with the IT specialist, they tested the controls, they did a random checking of the documents, right? They also did reperform the test of computation, etc. Now, if you look at this paragraph, it is very clear. In the key audit matter, they have identified what could be number one risk in this company's financial statements. Number one, two, three. There are about three or four, but I've just taken one of them. Right. What are those risks that you would find in this financial statement? Once you identify those risks, you will have to mention, okay, out of this risk, what can go wrong here? Possibly the non-compliance with the standards is a risk, right? WIP could be a risk, valuation could be a risk, possibility that revenue itself is not recognized as a risk. There could be a lot of risk. Then you will have to mention what audit procedures have you done to mitigate this risk or to curtail this audit risk. Should you conclude on your opinion? No, you don't have to conclude on it because you are anyway giving a conclusion on the overall financial statements, which includes revenue recognition. So you don't have to conclude. You just have to mention this is the risk and this is what is our audit procedure. If at all there's a negative opinion, then it should come as a qualification or an adverse opinion, and not as a key audit matter. This is the funnel approach. We call it as a funnel approach. That means all those matters which are those charged with governance first has to be identified. From that list, you need to select what is of that significance to the auditor. Within that significance, you have to prioritize some of them, and then that becomes a key audit matter. So when we say matters communicated with those charged with governance, it could be from SA 260, it could be on your responsibilities and independence, it could be setting up the materiality levels, it could be on the internal controls, it could be fraud risk. All those list of items that you communicate with those charged with governance, you first have to enlist it. From that, you need to filter out which one of those actually are the points that the auditor spent a lot of time. As Sir David Whitty said, we have a lot of things, but in that, very few of them would have given you sleepless night, so to say. What are those items? Identified. It could be, as examples, related party transactions, some unusual transactions, some management assumptions or judgments which are really outlandish or which is out of the way, right? Certain regulatory requirements. For example, uh, uh, provisioning is a requirement under a particular law or a contract, right? Many companies have given certain notes on COVID-related aspects. That is something again which I would like to discuss with you at the end of the 701 presentation, right? So there could be a lot of significant matters within that list. You just have to shortlist them. I would use the word shortlist. In that shortlisted, you have to identify, okay, I had some 10 issues that I discussed with those charged with governance. Out of 10, I found that, say, 6 of them are really, really very important. And within the 6, if you look at it, you would have got intense discussions with the management, or you would have used external experts, right? Or there is some accounting which is way out from what the standard says or the industry is doing it, or when you determine the materiality levels, your uncorrected mistakes are way above that, and you are challenging certain decisions of the management, etc. And it is definitely that when these things happen, significant audit time is also going into it, etc. These are all very, very subjective issues also. So within that 6, if you find that, okay, finally, there are certain things which has to be not as a qualification or as an emphasis, but something which really, really the stakeholders should know. That would become a key audit matter. Now, what could be the exceptions? There are only 2 exceptions given. One, if there is a law or a regulation which precludes public disclosure. For example, in IRDA guidelines or in banking, there are a lot of clauses on confidentiality, right? So you might have discussed, say, a particular loan account while you're doing a bank audit, and you have intense discussions. finally the management agreed to do a particular accounting treatment. You cannot disclose that name of the borrower or the terms of the contract because it is governed under certain statutes that you will not be giving certain public information. I'm just giving an hypothetical case, that's it. Similarly, there could be cases where if you disclose certain information in the audit report, it could outweigh the public interest. That means it may be really, really damageful to the company or to the client. So you will have to think twice before giving it. Or if the information is publicly available, anybody can Google it and figure it out. Why I'm saying Google? Because that's what everybody does today. You have the information in public domain. If I can say that, nothing precludes you. You can still disclose that. So again, if you would ask me, is there any list of things that would be covered under SA 701? No, there is no standard list. It depends on company to company, industry to industry, economic situation, right? The operational cycles. It depends again on the auditor's perception. Very, very important is the auditor's perception. Does 701 apply to limited reviews and other results? No, these are not complete financial statements and you are not giving an audit report. Therefore, it does not apply to limited reviews. However, emphasis of matter and other matters will apply to even limited reviews also. So, since the standard is mandatory for listed entities, it could have been listed or unlisted during the year. Now, this is a very interesting question. Now, it is quite possible the company is unlisted at the start of the year. By end of the year, it could be listed. Or the other way around, it could be listed at the beginning of the year and remains unlisted at the end of the year. So the implementation guide is clearly mentioning that the company should be listed on the reporting date, that is on the balance sheet date. If it is listed on the reporting date, then SA 701 will definitely apply and it is mandatory to have a paragraph in the listed company's audit report. Otherwise, it is not mandatory. Is it applicable, say a company is not listed in India, but it is listed on a foreign stock exchange? Yes, even then SA 701 is applicable if though the company is not listed in India. Because the word used in SA 701 is it has to be a listed entity. It does not say it has to be listed in India. Therefore, it will apply even to a foreign listed entity. Should KM give a separate opinion? No, you don't have to give. As I said, anyway, you are giving an opinion on the overall financial statements. KM is part of a particular thing in the financial statements. Therefore, you don't have to give any opinion or you don't have to conclude on. Can there be a report which is modified and also a KM? Yes. You can have a modification and also bring a KM, but it is limited only for a qualification or an adverse opinion. If you are giving a disclaimer of opinion, then KM will not apply in that particular case. Because in case of qualification, you have an audit evidence. Your audit evidence indicates that the accounting treatment given by the company is incorrect. That is why you are qualifying. Or you have an audit evidence, but the company has not given that accounting treatment and it is pervasive in nature. Therefore, you are giving an adverse opinion, or possibly the audit evidence is not sufficient enough when you are giving an adverse opinion. But when you are saying that I don't even have an evidence, that is why I'm giving a disclaimer of opinion, then obviously nothing is there to give it as KM. In fact, I would say implicitly the disclaimer of opinion itself is like a KM because you are unable to even report whether the financial statements show a true and fair view. You are unable to perform certain audit procedures, and hence, wherever there's a disclaimer of opinion, KM would not apply. What if the matter in KM does not have disclosure in financial statements? Typically, whether it is emphasis of matter paragraph or KM, if I just have to take back to the example we have given, if you look at here, I will just try to see whether I can have some research in there. If you look at here, they have given refer note number 4A. That means there is a particular note in the financial statements or note 10 which is to be referred to. Same case with emphasis of matter paragraph. Unless there is a note given, cannot give emphasis of matter. But then in 701, it is not necessary that there has to be a note, because it could apply even to non-financial aspects, like as I have given implementing IT system, right? In those cases, obviously you cannot give note references, then giving reference to note would not be applicable. Should you be reporting on the previous year's figure? No, we should not be giving KM for the previous year figure, because if in SA 710, there's a very clear-cut demarcation between corresponding figure and comparable figure. There's a very, very big difference in it. Normally, in our language, we typically interchange these terminologies, saying that why comparative figure is not given. Sometimes we say why corresponding figure is not. We think it is the same, but technically it is not the same. When we say a corresponding figure, in corresponding figure, we give the information because it is required by your Schedule 3 to give previous year figure as a reference point. That's it. When we say a comparative figure, the language in the audit report itself will be different. Some of the European countries where they follow international standards of auditing, when they prepare the audit report, they mention that we have audited the financial statements, which includes balance sheet, etc., for the year ending 31st March 2021 and 31st March 2020. That means in that audit report, the auditor is owning up even for the previous year's figures. That regime is called as, or that system is called as comparative figure. But what we are following in India is corresponding figures, because when we give an audit report, we only mention that we have audited the balance sheet as of 31st of March 2021, for example. We don't write previous year, though the financial statements are given. That's the basic difference. Can there be different camp for different years? Definitely yes. Again, it's highly unlikely that the business has so changed that you will have a completely different KM. But if you look at the trend from the last 2 years or 3 years, or even at international level, companies within the same industry are likely to have the same KM, likely to have. I'm not saying it should be the same. If you look at all the steel manufacturing companies or all IT companies, you will find that the KM is more or less the same. There could be 1 or 2 points here and there, but revenue recognition, for example, you go to any software company listed, revenue recognition is a KM. Is it possible for different entities in same industry to have different? Yes, it is possible. As I said, it is entity specific, and it depends from year to year, business model, auditor's perception, etc. Now, there are questions which people would have asked is, what if there was, I did not have any KM? Unfortunately, for listed companies, you cannot have that scenario. For listed companies, you have to give a KM, at least one. You have to figure out one KM, and definitely you have to give it in the listed entities. But for other unlisted companies, it is not mandatory, therefore you may not choose to give. Does it apply to consolidated financial statements? Definitely it applies. And auditor, as I said, has to comply with SS 600, where he has to give auditing or the group audit instructions to its subsidiary or the component auditors, take their report. When he prepares the KM, they have to consider the KMs of the respective components and then conclude at the consolidated level whether this is worth to be mentioned as a KM. What happens in case of joint auditors? Well, in case of joint auditors, all the joint auditors are responsible. So you need to interact with the joint auditors before issuing the KAM. So I'll just close my presentation for some time and take you through some of the case studies that I have. I'll have to just share some of the other files that I have. Okay. let's look at some of the reports. Just again, this is purely for our understanding. That's it, nothing else. Are you able to see my screen?
Yes, sir.
Mr. Lokesh or Pradeep,
Yes,
my
sir.
screen is visible?
Yes, visible, sir.
Okay. So this is typically in, I have masked as far as possible, then I have masked the name of the auditor and name of the company to the best of my knowledge, because it's just for academic purpose, and just to give, a statement that I'm not saying this is right or wrong, or we are not standing in any judgment position. I'm just trying to give you a flavor of how different auditors have given their reports, right? Some of them are pre SA 701, that is fine, but let us at least go through some of the typical audit reports. Now, this is one of the audit report of and all these audit reports are in public domain. So this is a particular audit report of a company which is in the, what do you call, electricity distribution business. But then the audit report, if you look at it, typically this audit report, right, uh, has a basis of disclaimer of opinion, right? That means these are the cases where the auditor disclaims certain statements, which says that in case of so and so balance confirmation or compliances to MSME, purchase of power, etc., he is unable to what do you call it as report on the accounts. What happened? Just a second. Okay, so this is a disclaimer of opinion given. Interestingly, if you scroll down further, there is in the same report they have given basis for adverse opinion also. In this particular audit report, the beauty is this particular auditor has also given a qualification also in the report. This is adverse opinion, this is disclaimer, adverse and qualified opinion. Why I'm trying to bring this out is it is now very difficult for a stakeholder. For example, I am the reader of the financial statement. How do I understand this audit report? Because if you read the sentence, it says, except for the effects of the matter described in basis of disclaimer opinion, qualified opinion, and adverse opinion, the financial statements give the information required in the manner so required and give a true and fair view. How would that be possible is something which any reader of the financial statement would like to understand. The reason I'm saying this is, when we are preparing the audit report, we should keep in mind how will the reader perceive it? How is it going to add value to the reader? Is it going to create confusion in their minds? So, as long as possible, that our audit report should be understandable. That is the word used in SA 700, the implementation guides also. When they say understandable, it should not be ambiguous, it should not be vague. As much as possible, try to bring clarity in what we are expressing an opinion. And when somebody would look at it and say, what type of opinion does this audit report carry? It will be very difficult thing to answer. So this is something that I just wanted to share with all of you. There is one more report. It's not loading. I don't want to say this. There's one more report that I just wanted to share with you is okay. This is again a listed company. In this particular case, if you look at it, there are too many qualifications, right? It's all basis of qualified opinion, where they say the inventory aging analysis is not available, the physical verification has not been done, provision for non-moving and obsolescence has not been done, right? There is an issue in the revenue recognition. There is an issue in investment valuation, right? Then there are certain terms of contract that they have not yet entered with the government department, right? Then they have issues in impairment of assets, fixed assets, procurement policies, right? And branch auditors have also given a qualified report saying that. Now, interestingly, if you see the last here, the paragraph, right? It says their report stating that sufficient and appropriate audit evidence were not provided. So the auditor is clearly saying that I don't have audit evidence for opening and closing balances of bank accounts, trade receivables, claims, loans, advances, inventories, materials, fabricators, subcontractors, material in transit, deposits, loans, and other payables, receivables. Auditors have further stated the opening balance also may not be free from misstatement, etc. These are the cases where it is qualified and they are unable to quantify. Now you have again one more list of cases where there are a lot of qualifications which are quantified. Now any reader would, if he goes through this, typically if you link this to the balance sheet, you have inventories covered, you have fixed assets covered, you have investments covered, right? You have leases covered, you have your internal controls covered, right? Then you don't have an audit evidence for your receivables and payables and the loans and the advances, etc. But then the auditor would only give saying that it is a qualified opinion. Should it not be adverse opinion? Somebody would say, because I don't have evidence for most of it, or even if I have, it doesn't substantiate what is given in the financial statements. So whether qualified opinion is good enough, then again they have certain opinion given for emphasis of matter paragraph also, which I'm just going to take you down. Emphasis of matter again, right from their cumulative preference shares are overdue. It's a Sick Industries Act, right? Then here, if you say balances in accounts of trade payable, advance from customers, trade pay, receivables, the whole lot of things. Either they lack evidence or they are subject to confirmations, right? Now, the question then comes is it good enough to be emphasis of matter? Just because there is a note in the financial statements, is it good enough? I would say it is not emphasis of matter. This is personal view, because these are the cases where if you don't have an evidence, you straight away go for either a qualification or adverse opinion or disclaimer. It is not right to give it as emphasis of matter wherein the management has indicated that these are the issues. So this is another typical audit report that I thought I could share. Last but not the least, I have one more which I just want to quickly share with you. Is now this is again an audit report from a UK-based company. Why UK-based? Because I just wanted to showcase what could be the possible changes going forward in our audit report. It is going to have something like this. We never mentioned materiality amount in our audit report, but in under ISA, there's a requirement. For example, in this case, they have mentioned what is the group materiality, what is the company materiality, how are they identified the components, what is the risk assessment they have done. We don't give specific risk assessment. We just mention what is risk assessment. But here, they have specifically given long-term contracts, deferred tax, foreign currency denominated transactions, leases. So these are some of the typical risks that they have identified, right? And they have given what is their audit approach towards that. So in our audit approach, They have given an entire thing that how they have evaluated the management information system, their IT systems, internal audit, etc. Interestingly, if you see, they have also sort of given likelihood of potential misstatement. This likelihood of potential misstatement, they have given it in a graphical manner, which is allowed under ISA, but it is not allowed under Indian scenario. But possibly it might come up in near future. Even for key audit matters, as I said, it will not be given for the previous year. But what ISA requires is you have key audit matters and other risks at the group level or at the company level. Was it there in the previous year or not? So long-term contracts, if you see this symbol of two arrow marks in opposite direction, that means it is not. I mean, it is there in the previous year, it is there this year, so there is no change. But if you see response of the group to the deferred prosecution and leniency arrangements with alleged bribery, it was there in the previous year, not in this year. That is why they have dropped an arrow signal. And if something new has come up, they have given it as new. This is an information given to the stakeholders to see that whether this was a key audit matter in the previous year or not. Similarly, they have also given changes in the risk and the audit procedures. I can share this for the benefit of our audience, and they can pursue it whenever they are free or when they feel like they want to go through it. Another important change that is covered in the ISA, which we are going to have it, is how have we tailored the audit scope? How did we design our audit procedure? It's something which we don't give in our audit report, but here it is specifically required. For example, they have given our audit covered 90% of revenue, 86% of loss, 85% of assets. All entities that contribute in excess of 4% of the group's revenue were included in the scope. One more area that the audit report also contains is this aspect of materiality and how they have defined it. There is a table given here on what is the overall materiality, how is it determined, and what is the rationale of using this particular materiality level. Now, typically, this could be like a double-edged sword, if you would ask me. One place you may argue saying that, yes, anything less than that, please don't ask me, it is less than the materiality level. On the other side, if there is a potential issue that comes up, and you cannot take a materiality shelter there because you have already disclosed. Say in this case, if they get a case of $100 million, well, it's a pounds. They may say, sorry, this was above your materiality level. Why was it not reported? Right? Then they have also given what are the material misstatements that have not been corrected and which is below the materiality level. Very, very important is going concern. As I said, going concern, now the obligation in India is to report only when there is an issue. But here, even if there is no issue, the auditors would have to disclose as to how the going concern assumptions have been evaluated and what is the outcome. Typically, this happens in a European setup where the holding company auditors more or less would be doing the audit of subsidiaries also. But in India, it is slightly different. We are yet to get into that level. And of course, there are other regulatory reporting requirements on when were they appointed as auditors, what is the tenure, which we basically cover this in our annual report in the directors' resolutions and all that, but not here in the members' resolution, not in the audit report. So these are some of the three case studies that I just wanted to share with you. Let me go back to our presentation. Okay, so I'm going to do this. So I have to just open this. Right. So this is where we were on the case study. Moving on, again, this is something which I had already covered. on SA 500, that is the third standard that we are dealing with. 500, 501, and 330 basically are smaller standards, and it will not take as much time as SA01, but that these are also important standards. Two important things that are covered in SA 500 are: is it sufficient evidence and is it appropriate? When say sufficient, that evidence should indicate that you have validated this particular number. For example, there is an inventory valuation, inventory amount. If you have done a physical verification of inventory, that is not a value. You should have a valuation sheet, how you have determined the normal capacity, how that has been validated. But if you just have a proof that I did physical verification, it's only about the quantity and not the value. So very important to understand that what audit evidence is sufficient and what audit evidence is appropriate. What are the different types of audit evidences typically we have? At the start of the business, at the start of the audit, let me go to the planning stage. Thereafter, we do a process walkthrough of the controls or of the procedures. These are the inquiries that we do. So when we do an inquiry, we typically note down the minutes of the meeting, send out a mail, or take their acknowledgement. That is an audit evidence. Similarly, when we ask for the legal advisors to talk about litigations, the status of that, which sometimes some of the legal advisors do give a note, but at times when the note is not available, it is your duty to connect with the legal advisor, inquire with them, send out the minutes of the meeting, and get an acknowledgement. That would be an evidence for that particular assertion. When we normally work in an IT environment, say in SAP, the depreciation run is done on a monthly basis, because once the assets are capitalized, the life of the asset is configured in a master file, and every time a depreciation run is performed, the depreciation is calculated. Now, as an auditor, there are 2-3 things we need to think. Apart from checking the ITGC, the general controls and application controls, we have to take few samples from the depreciation calculation, redo that calculation outside the SAP environment, maybe use an Excel sheet or possibly a calculator, whatever it is, and then see whether the results what you have got matches with that done by SAP. That is called as recalculation. Reperformance, typically examples will be where a statement is already prepared. For example, a reconciliation statement, a bank reconciliation statement. So as an audit procedure, our standard practice in our firm at least is to reperform BRS of one of the months. Need not be for the month of March. It could be any of the 12 months. Say if they have 4 bank accounts, possibly I would take one for May, one for July, one for November, one for January in each of the bank statements or the bank accounts, and redo the BRS and then see whether the results are the same. That is called as reperformance. External confirmation, as the name goes, we get it for receivables, payables, bank balances, etc. One important thing that FRRB always comes up with, when or 2 things. The external confirmation should always be received by the auditor at their address or at their email ID only. It cannot be given by the client. For example, when we do a confirmation for a bank, we request the client to intimate the banker, because otherwise the banker will not know that we are the auditors. How will they know? So the client has to intimate the banker that so-and-so chartered accountant or so-and-so firm are our statutory auditors, and they will be requesting for confirmation of balance. Please oblige them by giving the confirmation. That's it. They don't have to do anything else. That letter has to be given to the bank. The bank then has to send a confirmation directly to the auditor's office. Please ensure that if it is sent by post, you have a cover indicating that it is sent to you. If it is an email, it should be addressed to your ID only. Of course, you have certain IT portals like say confirmation.com, etc., where you don't have to worry about all this. They take care of all the procedures to be complied with SA 500. And once you upload the balances, confirmation.com will get it from the bank or get it from the receiver, the payer, the debtor and the creditor, etc. The second very important aspect is if you have not received a confirmation, please ensure that you send at least one or two reminders. That is also a requirement under SA 500 that you send them the reminders. Even if there is no response, then of course you can always claim that I tried my best, I was diligent, I did my duty. If the other party does not confirm the balance, then you will have to do alternate audit procedures, possibly checking both post-balance sheet payments or receipts, or getting some other evidence to confirm the balance or to confirm the assertion. Then comes observation, which is covered under SA 501 for inventory count, where we observe certain things. Similarly, very close to that is inspection. Certain inspections or watching we do, verification of title deeds of land, approvals, procedures. When we do this, we take a copy of that. That is called as inspection. So inspection, observation, external confirmation, recalculation, reperformance, inquiry, these are some of the audit evidences that you would have. Typically, some more examples if you have to give. Suppose you are depending on another auditor. You are doing audit of a multinational company here in India. The control for a particular thing, for example, control surrounding ESOP. Nobody does it in India for that company. It is done somewhere in US or UK. And you have no infrastructure or bandwidth to go to US and UK and verify it. Typically, then you can do two things. Request through the management auditor of that particular entity to give you a report on their audit results, which will be covered under SA 600 or 610 also in that series, management expert. Or you can also do alternate procedures if it is feasible. So you will have to devise your audits strategies or audit program in such a manner that you get your audit evidence which is sufficient and appropriate. As far as the reliability is concerned, yes, the external sources are more reliable than the internal sources. Therefore, we take external confirmations. Oral, definitely not accepted, especially in the era now that we are in controls and system. The rule is simple, the mantra is simple. If you have performed, you should have a document. If there is no document, it is as good as it has not been performed or the control has not been performed. It is come to that level now. Electronic forms definitely are now more and more accepted, especially in light of that we are all working from remote locations. Having said that, ensure that wherever possible, these electronic documents are password protected, are digitally signed, right? At least the crucial documents. And we would not typically use Word or Excel documents because they are prone to be changed unless it is for some analysis and for other things. But the final document has to be in a non-editable format, which would give more credence to it, right? Analytical versus substantive procedures. Substantive procedure always gives a higher hand because you would be looking into external documents, underlying documents like contracts, vouchers, approvals, which would give you the validity of that particular transaction. Analytical procedure also is good, but then it gives you only at a macro level what could have increased or decreased a particular assertion in the financial statement. These days, when we say analytical procedure, it is not only restricted to just doing a trend analysis. You have theories like Benford's law. Uh, if one of your members are interested to know what is Benford's law, I'll be more than happy to take a 2 or 3 minute session on that. Benford's law, using correlation theories, using data analytics like Python and other programs where you can actually analyze 100% of the data. Moreover, in the advent of artificial intelligence and machine learning, honestly speaking, the era of sample checking is gone. The era of sample checking is only a matter of time. More or less, it's on its verge of death. Because if an audit firm is using AI or machine learning, you can literally do 100% audit with lesser resources, lesser cost, and more effectively and efficiently. Use of an expert is always welcome because that gives an added comfort that there's a professional who has done it, who has got a certification in a particular area. For example, actuarial valuation. Why are we hell bent on taking actuarial valuation report from an external actuary? Does it say that it has to be done by an external person? In AS 15 or in AS 19, it mentions that the actuarial valuation report should be done by an independent actuary. That's the reason we take it. What if, when, for example, you have to do an ESOP valuation, right? And Black-Scholes model has to be taken. The company has a very good team of chartered accountants and they prepare their own valuation. You can still go with it, nothing wrong. But if they appoint a valuer and gets it valued, it lends more credence to it. That is more important. As far as the relevance is concerned, again, it is about the quality of it and how accurate it is. Again, when it comes to reliability and relevance, I would feel relevance is more subjective than reliability. Uh, but relevance is also required to substantiate, whether a transaction is good enough, whether does it carry any qualification in the audit report. To assess that, yes, definitely it has to be relevant as well. So broadly, this is what is governed in SA 500. Now, if you have to look at what should be the qualities of a report that you are getting, especially if it is given by management's expert, you should be looking into, is the matter so complex? For example, actuarial valuation. Not many of us understand the demographics. Not many of us understand what should be the insurance table that is being used. What should be the longevity risk or investment risk, etc. Same case with a lot of mathematical calculations are involved, which requires an expertise. So it again depends on the management's expert. How is he independent? Right? What is the regulatory environment? That is very, very important. Many times what happens, say for example, a company may have an in-house internal audit team. But if you actually go through their background, I'm not degrading or I'm not demeaning anything, but none of them could be a qualified chartered accountant, or none of them would have actually gone through any internal audit courses like IAA or CIA or CFE, something like that. Possibly then you'd start getting an apprehension that what could be the quality of the work they've done. It is quite possible that a person need not be a chartered accountant or need not have passed IAA. He might be doing an excellent work in internal audit. But that certificate and that regulation is very, very important, right? It's not that somebody else cannot do the audit. They can, but they're not allowed to, right? Somebody else can do a statutory audit. Why are they not allowed? They are not chartered accountants. There's a regulatory environment for that. Similarly, what is the area of expertise of that particular expert? What are their competencies? How are they associated with this entity? You need to really evaluate before relying upon the management's expert, again, which is covered under a different standard altogether. Now, when you have that evidence, under SA 501, there are 3 or 4 areas that have been covered. One is typically when you are looking for inventory, what is the evidence you need to do? When you have to checking for the litigation, what is that you're going to do? When it comes to segment reporting, this is again something which I need to discuss a little more in depth. Now, when you're doing inventory verification, very, very important here is it necessary for the auditor should go to attend the physical verification? Some of them argue that why should the auditor go? What is that we are reporting in Caro? We are mentioning whether the company has maintained inventory records. whether a company has done physical verification of inventory. So why should the auditor be involved? It is not for the purpose of audit. It is for the purpose for you to, you means the auditors to know whether that inventory existed on that particular day. Existence of an asset is a financial assertion. Completeness, accuracy, obligation, existence, valuation, these are all financial assertions that we need to consider when we are doing planning of the audit or the auditors. Therefore, when there is a physical inventory count to be done, in my view, yes, the auditor has to be there. Should I go only on 31st March? Need not be. You don't have to go only on 31st March. Though highly recommended, and most of the companies, 99.9%, they will always have physical verification of inventory at period ending, because it will also help them to ascertain the quantity and the value of inventory. So it goes without saying that companies or the auditors will definitely attend the physical verification. For some strange reason, if you are unable to go, for example, because of COVID, you are not allowed to go. But what else can you do? You can still do, if you have done a physical verification just before March, say you would have done it in the month of February before the lockdown, or say in the month of June, the lockdown is up, you're free to move with certain conditions, of course. You do a physical verification after the year end. Then there is something called as rollback or roll forward procedures. Rollback means from February results, you will find out, you will add all the purchases, add all the production, right? Consider the sales, etc., and arrive at 31st March. Or you take the management's figure of 31st March, whatever they have arrived, add purchases, production, sales, you do all this mathematics, arrive at what you are doing physical verification today. So rollback and roll forward procedures can also be done. Now, in typical scenarios where it takes substantial amount of time to do the physical verification and the audit has to be completed, say in the month of May or June, which in fact one of the audits that we do, we finish it in the month of April when there was a lockdown, or May. So what do we do? Use electronic means under the guidance not given by ICA for COVID this thing. Otherwise, also you can still use electronic means. That means possibly you can you can ask the client to arrange a video, for counting the particular inventory, and you can ask them to show a particular inventory, count it, ask somebody to count there, and you have to record this video as an audit evidence. That is possible. Second, where it is possible is in areas where technology can be used. For example, I know one of our clients, which is in petroleum industry, they use drones to know a particular depth or to know the particular availability of a particular asset or a resource. Yes, permitted. Again, there are certain guidances available as to how you can use this. Geospatial techniques possible. Third-party confirmation on warehouse receipts, or especially where the inventory is with a job worker, etc. Yes, you have to get a third-party confirmation. So you will have to look into what different means that you can use to get a comfort on that particular inventory. We have a client which is basically in the business of electric vehicles. They are also have set up what you call it as the charging stations across the city, which is a fixed asset for them. How do you physically verify? Though we are talking about inventory, I'm just giving an example. How is it possible for them to, now and then check the availability of that particular charging port, which runs into hundreds and thousands now for a period of time? Each and every port has a GPS system, and from that, in a very short time, they will be able to know whether they are in the location where it is supposed to be and whether it is functioning. Similarly, many of the companies also use RFID tags. Based on that, they figure out what is the quantity. There are certain applications available now on your mobile which will help you to even count, take a picture, it will at least count what is the inventory. This could, you may consider that it is a deviation from the topic, but then what I'm trying to say is there is a lot of technology available, and to give an excuse that I was not able to attend physical verification may not hold good. But having said that, it comes with a cost. The client should be ready to appreciate that. The auditor should be able to appreciate this procedure, etc. Depending on various factors, they may choose to do or they may not choose to do. Going to the next one would be on litigation and claims. Litigations and claims, very, very risky area, because you may not find any of that in the journal entries or financial statements unless you actually go through the professional fees paid to the advocates. I mean, even if it is not paid and not provided, uh, it becomes really difficult to know. So certain steps you need to do is review the minutes of the board and the audit committee, talk to the legal advisor, right? Pursue the the professional fees that are paid. The best evidence that you can collect here is get a letter from the legal advisor on the list of various litigations that the company is having. What is the status of that? When is the next hearing? Why is it taking so much of time? What possibly could be the cost that the company would have to incur if they fail in that litigation? Right. Here, it is very, very important from the point of view of accounting standard also. Why? Under accounting standard 29, you may have to either provide for certain liabilities or certain payments, or you may have to at least show something as contingent liability also. So it becomes really, really crucial for compliance with AS 29 on litigation and claims. In fact, for India AS 37, it is all the more important because apart from provisions and contingent liabilities, you will also have to disclose contingent assets also. And most of the time, the contingent asset will typically be a case where the company has filed and there is a good amount of probability which the advocates would claim that they are going to win the case and they are going to get money out of that as damages, etc. So it's very, very important, even from the accounting standard point of view, to concentrate on litigation and claims and either get a letter from the legal advisor on the status of the cases, if possible, or rather, if it is not possible, have a discussion with them and ensure that it is monitored. Segment information is also again very, very important. Now, typically, what happens under AS 17? Under AS 17, you would go through the P&L account or the person who is preparing the financial statements. From the P&L account, they dissect the P&L account to figure out whether something has to be a segment reporting or not. So typically under AS 17, if 10% or more of the revenue is coming from a typical revenue stream, say a company is in the business of, say, it is selling computers, it is doing software, it is doing an AMC service, right? It can have some other business also, right? In that case, logically, it should have 3 or 4 segments. And under AS 17, you would one would be disclosing what would be the revenue from operations from each segment, reduce it from the inter-segment revenue, and revenue cost, revenue profits, and typically, segment revenue, segment cost, segment result, and segment assets and liabilities. Where it is not possible to allocate assets and liabilities, it has to be mentioned, it is unallocated. Now, this again, what type of segments are this is to be considered if only to understand the business model or and you go through the merits of the meeting. When you are doing Ind AS 108, it is completely opposite in the way the segment reporting is done. In AS 17, you are doing from the P&L account to figure out. Whereas in 108, we look at how the management is looking at the business. We are not looking at the P&L account. We are looking at how the management is looking at the business, what type of reporting they are looking into. Then we can then disclose that as the business. For example, in the instance where I gave that a company may be having hardware business and software business and AMC, etc. Under AS17, you might be showing this as a primary segment. If you have exports, you would be showing it as geographical segment. So in AS17, again, you have to determine whether your business is more of, risk is geography versus domestic or product wise. Some companies give both as a matrix segment. Now under India's 108, there is nothing called as primary segment or secondary segment. It is a business segment that the CODM determines and how they look into the business. A. B. Under AS17, you would also ensure that the segment reporting is also follows the same accounting policy as of the financial statement. That means when you're saying revenue from hardware business, revenue from software business, that revenue should comply with AS9. Whereas under Ind AS 108, it need not comply with any of the Ind AS because it is managed. You are looking the business from the management's point of view. Then point number C. In AS17, typically your profit or your segment profit, when you add up all of them, will match with your P&L. In 108, it need not match. And where it doesn't match, you will have to give a reconciliation. So like this, you have different standards requiring different disclosures. Again, in 108, you will still have to disclose, are there any customers contributing to more than 10% of the revenue? Not there in A70. So depending on the requirements of the standard, you need to design your audit procedure, understand the business model, see how it fits into either of these standards, and then design your audit procedures. This is broadly under 501. Coming to the last topic on SA 330. Again, SA 330 is basically covered with the starting from SA 315. So I would like to touch upon 315 in a very brief manner, even before going to 330. Now, in SA 315, we talk about how do we assess the risk of material misstatement through understanding the entity. So when we are given a balance sheet or the financials of a company, that talks only about what is there in the books of accounts. There is something which is there beyond that as well. So typically, in the audit planning stage, we would consider the business model, the industry in which it operates, the regulatory environment, the competition, right, and the recent economic scenario. All this has to be considered while identifying the risk of material mistake. Now, when we actually look into the financial statements and start scoping what risk it carries. In fact, I have a document with, but since it has the client's name, we will not be able to show it. But then I can explain what we have done. For example, in a company like a software company, you would say one of the risky area that you would have identified is, say, revenue recognition. Now, you need not identify something is risky or not risky at the first stage. You just have to look into the P&L account. Against each line item in the P&L account or the schedules, you will have to determine what could be the potential risk against each one of these line items. Let's take an example of, say, employee benefits. What could be the typical risk? Typical risk could be ghost employees. That means you have employees who are actually not there, but payments are being made, or the payroll register and the GL have not been matched, right? Then gratuity and leave encashment valuation is incorrect, or you have not complied with certain labor laws. There could be issues in relation to non-payment of salaries, right? Or the salary that is being paid is not in line with the increment letters or the appointment letters. There could also be cases where the salary is paid in cash and not getting accounted. So against the employee benefits itself, you will have some 20 different type of risk, which you as an auditor would have assessed when you are looking at the accounts of the company when you are talking to the client. Now, against that risk, what is the possible controls that the company has, first of all? Now, for example, for ghost employees, possibly you will have to look into the attendance register and the efficiency of the attendance records. If it is biometric, it is all the more good, right? Looking at the PAN numbers, whether there is any duplication, looking at the bank account numbers, whether there is any duplication. You can also look at cases where employees would have just worked for 15, 20 days or 1 month and they have left. And those kind of cases are quite huge. So there are various ways you will have to figure out and rule out at least reasonably that that this risk is mitigated. Now, after that comes whether these controls are, preventive controls or detective controls, or is it IT or non-IT, etc. We are not getting into. Once this control is established, next comes whether, again, you should also involve whether there could be cases of fraud also, fraud risk assessment. Once you identify that against employee benefits, you have 20 type of risk, against this risk, there are controls. Now the question is, this is a control that you are expecting as an auditor for the company to have. It could be match it with the controls that are actually the company is having. You may find there is a gap. You might expect that the company should be having these type of what do you call it as a typical or a standard uh, control, but they may have certain controls in place which could be quite different. When you compare that, your three things can happen. Either the company doesn't have a control, or the control is there but it is not effective, or they have not identified that risk, or they have not identified that risk, therefore there is no. Wherever there is insufficient controls, or where there are controls for which, or there are risks for which there are no controls, you would normally classify it as high risk or medium risk. Where there are controls, you again go ahead, test it. Based on the test results, you would be either satisfied or not satisfied with the controls in place. Now, those cases typically where you do not have a good control or the controls are insufficient, then you start looking into how material it is to the financial statement. That is, keep it aside. Once you find out that something, you still go ahead and do your own. Three things can happen. Either you find the control is good enough, though they may not have documented it, you don't have to do anything. But where the control has failed, if it is a deficiency, very minor one, you still discuss with the process owners and report it to the management. But if it is a significant deficiency, you will not qualify the report, but you are just going to report it under SA 260 to those charged with governance, to those charged with management where it is suitable. But where you find that the control is completely lacking and it could lead to material misstatement, that is where you will have to qualify in your IFC report saying that there is lapse of control or there is no control. Once a material misstatement control report is given as an adverse opinion, you would then have to correlate that in the main audit report also to say that because the controls have failed, we are unable to give comfort on this particular assertions of employee benefits. This could be the potential. Now, similarly, like how we have qualified emphasis of, qualified adverse and disclaimer, even in IFC reporting, you either have to give a clean report or modified report, which could be qualifying the controls or adverse opinion saying that the controls are not at all effective, or you will have to end up giving a disclaimer which says that we are unable to assess the controls. Again, it depends on various other factors. Once this is all done under 315, then you go on, how would you respond to that risk? 315 assessing the risk. How would you respond? You would respond by doing a combination of substantive procedures or test of controls, or leveraging the results of test of controls over substantive procedures. Say, when will the scenario arise? Say you are doing audit of a big company where there are 10,000 line items, right? Or there are ongoing transactions all the time. Say you are doing audit of a bank where the banking transaction keeps happening, or you're auditor of companies like Swiggy or Zomato where there are lakhs of transactions happening. Obviously, you cannot be doing substantial procedures for all of them. You can only do for certain samples. But that certain sample may not give you good comfort because it at best you can do 1% or 2% of those transactions at best. Remaining 98% will remain unaudited. Then you have to ensure that the controls are in place. The controls are effective, whether it could be IT control or otherwise. Very important to ensure that the controls are effective. So it depends from company to company, industry to industry, how much you can rely upon a substantive procedure and how much you can rely upon the control testing. Even when it comes to sample selection, which is again covered by different standard, uh, I would not normally take a random sample or a haphazard sample. I would try to take a scientific sample always because it gives me a confidence that I have done it based on some scientific basis. I mean, of course, these days you have softwares which will pick up the sample based on the data analysis as well. Again, in our own Excel sheet, you can take random number sampling as an example where you can use it to select the samples. Based on that sample selection, you go back to SA 500, see what is the audit evidence required, and then do the adequate audit procedures to ensure that the risks that you have assessed are mitigated. Again, our audit procedure, again, dependability of likelihood of material misstatement at the financial statement level or account balance or at even the class of transactions. This is something which we have already covered on the test of controls. Uh, this is again, I would encourage all of you to read the guidance not given by ICA, which is very, very close to even SOX testing, etc., which will help to understand how you need to do. And one very, very important thing is in case of substantive testing, you have the judgment. You can say that I will verify 20 transaction, 30 transaction, 2% of the transactions, etc. Of controls under the guidance on IFC, the sample size is given in the IFC. That is the minimum sample that you have to verify, unless the transactions itself are less than that. If you look at the guidance note on IFC, there is a chapter on how the samples have to be selected based on whether it is a daily transaction, weekly, monthly, quarterly, yearly, or once in a way, or it's a continuous transaction, and whether it is a high, medium, or low risk. For low risk, obviously the number of samples would be less, for high risk, the samples would be high. Please ensure that when you are doing IFC testing, those are the minimum IFC numbers that we have to verify. I don't have to text because it's more of watching and verification, right? This is already covered in SA 500. Again, depends on the adequacy and adequacy of the information that we have on hand, the nature of the client, the business, the assertions of the financial statements. All these factors actually influence our SA 330 procedures. So that's the presentation I had, and if you have any questions, I'll be more than happy to take it. Is there anything given in the chat box? Let's see.
Thank you so much, sir.
I think there are a couple of questions.
Yeah.
There was, how about absence of internal audit? Does it have an impact on the risk assessment consideration? Yes. Again, here I would answer in two stages. One, it's a case where typically, most companies take the shelter of saying that our company has an internal audit section, but we are not covered under that. Therefore, it is not. But if you look at from the other side, definitely audit will definitely help the statutory auditor. They can also rely upon
Aditya sir, it is better to
it.
stop the video because there is low bandwidth, sir.
Is that
Aditya sir,
permissible are available guide to determine the amount to report if just to report. Am I audible now?
yeah, now it is okay, sir.
Am I audible?
Yes, yes.
And now it's fine,
Okay.
sir.
Now it
Just
is
to
okay.
continue with the question. Just to continue with the question.
Okay.
It's okay, sir. I can hear you.
Sir, can you repeat the answer for that question, sir? Someone is asking. Actually.
Yeah, I'm trying to do.
Sure.
Yes, yes, yes. Can you hear me now?
And now it's clear, sir.
Okay. So I'm saying that yes, it is good practice for the auditor to give it in KA. There's nothing wrong. Any other questions, sir?
There is one question in Q&A. Although KMA is not applicable to a private limited company, it is permissible to include KMA in the audit report, especially when the fixed price contracts are entered into with the related parties. Although comparable prices are available as a guide to determine the arm's length pricing. Yet, would it not be good practice to report in KM?
The auditor is encouraged to give. It's a good practice.
There is one more question. How about absence of internal audit doesn't have an impact on the risk assessment consideration?
I have replied to that.
Only that much, sir. I have not
See,
received
internal
any-
audit, as I said, it's a good practice to have, and it gives a lot more comfort to the statutory auditor. But then, as I said, the Companies Act doesn't require compulsory internal audit.
Yes, sir. That's it, sir. There is no other questions, sir. Thank you so much, sir. It's time for vote of thanks. I request the chairman of Mysore branch deliver the vote of thanks. C.A. Kumar, sir, are you available there?
Yes, sir.
Sir, you can deliver vote of thanks.
Thank you very much, sir, for insightful webinar enriching the knowledge of our members, Mysore branch, Udupi branch, and even other branches. Now I request our senior member, CA Sabrishan sir, to say a few words on these 2 days webinar. Sabrishan sir, please unmute.
Kavita madam? No. Jana madam. Please make Sabrishan sir unmute, okay? He is in attendee list.
Yeah, he is there.
Video.
Good evening. Can you hear me?
Yes,
sir.
we
Yes,
can
sir.
hear.
Yes, sir.
Good evening. Good evening, everybody. The fair attendance today, yesterday, and today. And of course, for me, it's more of a academic fervor. I'm neither in practice nor in employment, but I'm still very much interested in the development of these standards as they go on. The last 2 days, we covered mostly standards on auditing, starting with SQC1 and various other SA. And I felt that they were quite extensively dealt with by both the resource people, CA Mohan Lavi yesterday and today, CA Aditya. But one observation I have for people who have attended, maybe they want to go and introspect. Typically in these seminars, one should expect a lot of Q&A. Q&A is a barometer of how actively involved a participator is, and it also gives the speaker a level of comfort on passing on the knowledge to the participant. The absence of questions could either mean that everybody knows this so perfectly well, they just need the CPA credit, and therefore they are just switching on and then maybe doing their own business. Or on the other extreme is that they think it is all too much for them, their work profile doesn't allow them to get into all this. But let me tell you, these standards have evolved over a period of time and they have a lot of impact on the practical work any auditor would do. Given that the tax assessment have become faceless, it will give you a lot of more time to focus on these standards, accounting standard, auditing standard, or even Ind AS wherever it's applicable. So my recommendation is that people who are new to the profession, maybe not very old in the profession, they should take more interest, form groups, form study circle, bring their own experience cases, apply these standards like we do study circle meetings for various other things. You should do study circle meeting for this, apply the standard to their own case, not disclose the name of the client, but the circumstances can change, the numbers, change the figures, change, but the circumstances can be dealt with and correlated with what is applicable, what is not applicable, and I'm sure there will be a great learning. So this is what is my words of, what shall I say, wisdom that I have gathered over 40 years of my experience. So I hope it is beneficial to most of you. Thank you, CA Kumar, for giving me this opportunity.
Thank you, sir.
Sir, just if I can just add a word in a lighter vein, just in a lighter vein. It could also mean that whatever speaker has said, they may not have understood also. Anyway, sir, it was a good session. I mean, the topics were good.
Thank you so much, sir.
Thank you
Thank you
for
so much.
Mysore and Udupi branch for giving this opportunity.
It's a great privilege for us, sir. Thank you so much.
And I've given my email ID and my phone number on the chat box. I'd be more than happy as a young speaker to get your feedback, whether it is a bouquet or a brick bag. I'll be more than happy to take it and see how I can improvise myself for a period of time.
We thank you, sir. We thank you very much for accepting our invitation and delivered very well, which has been seen the attendance till the end. All the members are still on the web platform. We thank you, sir.
Thank you so much, sir.
I thank Udupi branch for all technical support, especially CA Pradeep Jogi, sir. I thank all the participants. Hope let us see tomorrow afternoon, say 4 o'clock for accounting standards next 2 days. Thank you all.
Thank you, sir. Thank you so much.
Thank you, sir.
Thank you, Pradeep, sir. Thank you, Rohita ma'am.
Thank you, sir. Thank you. Yeah. Jana, madam, you can end the recording now.